Hey traders, Parker here. Bear with me. I'm still dealing with from the results of this last COVID shot, and my voice is kind of raspy. But I finally finished everything on the sector rotation model indicator, and I wanted to go ahead and start breaking things down to you or for you. Uh, with this, everything I want to go over the labels first. So we'll go to the labels first. You can see they're all labeled by their different sector. And the second thing you see in the labels is the actual price. This is going to be the days changed, but you're going to be able to put in there exactly how many days changed that you want to see. And this is the difference where it is in space between its 52-week high and 52-week low, and the S&P between its 52-week high and 52-week low. And it's done in a ratio, and it's right now it's saying it's 32 points above the S&P 500 where it is in its space, and the S&P 500 right now is at 19 in its relative strength. So this is actually if you add what 19 to 32, you get where it is with in its ratio with this 52-week high, 52-week low. So what I'm going to do, and that's basically what the labels indicate. Well, indicate in the labels, but the actual labels changing color gives you the depiction of their relative strength. The relative strength right now, if you look at gold, it's below 50, but it's between, but it's higher than 30. So you get this dirty looking brown color. Anything that's below 30 is going to show up gray when it comes to its relative strength. And what I'm getting at is relative strength within this ratio where everything sits. And anything above 50 will be this light green right here. Anything that's above 70 will be bright green. But anything that's above 50 and its short-term average is above its mid-average, it'll be cyan, giving you the best indication of that sector is still performing very well. But if it's a short-term average is below its mid-term average, it'll be the regular colors. And right now I have the short-term average is 5, and I have the mid-term average is 21. So that'll give you 5 days on the daily chart. That'll give you 5 days, and on the and the 21 to give you a month. So that pretty much shows you the labels. The VIX itself would change colors, varying on red. When it's below 10%, it'll be cyan. Other than that, it's gonna be some variation of red. And right now, it's way above 50, and it's red. So, and right now the price of the VIX is 31.76, and it's changed on this. I have the change right now set at 5 days, so its change is from 5 days is 56% change from its 5-day closing price. So we're going to the labels now, and you can see everything you could change. Show labels. That's actually something I need to take out. So give me one moment. The show labels was actually in there from the point when I had both indicators combined together. But once I started adding the different labels, I saw that they weren't going to be able to fit together. So if you want to cut the labels completely off, you still can, but it really doesn't make any difference. But you can change the average in here. Right now, you're going to be working with the 52-week long average. Don't mess with that. That goes with the week. The 21-day goes with the day. And the short-term average is right now it's set to a daily as well. But the day will control the 21 and 5. The week will control the 52. And the day change, like I said before, it shows you the 5-day change between the current closing price and the last 5 days. Or if you want to push it down to 1 day or 21 day, give you a month, and 63 give you 3 months change. So that's one. That pretty much sets the labels up. And like I said, you can change the average, and that's it for the labels. let's get into the sector rotation. The all this sector rotation indicator right here, other than the labels, this is just a visual representation of what's going on. I got all the labels in there. Everything's labeled, but I put it in there so that you can break it down with the groups. And you have in there your long ranges goes with the week, and the mid range goes with the day, the 21 day. Those are the only two that are in there. Don't worry about a short average in there. That's only for the labels, for them changing color and doing whatever they're doing. So right now, every one of these has an average, and it's all set at 21, and that's on a daily. The 52 week is actually for the 52 week high and 52 week low. If you wanted to see a 3 month low or a 3 month, if you wanted to fix the ratio where it's 3 month and 3, you'll just come over here and you'll put month and you'll put 3, and that works right there. But this indicator has so many more possibilities. Same thing with the labels. If you want to do that, you just change the week to a 3 month, and you change the average to 3. If you want to do a 3 month, 3 month high and 3 month low. So the possibilities with this is it has so many other possibilities and uses. So if you come right here, same thing. You can change the average to change these averages to whatever you want to change. Well, really just this the daily average. You can change to simple, or you can change it to exponential, or whatever you want to change it to. So the other average is high. It actually goes with what I was trying to remember yesterday: the communications, the semiconductors, and the biotech. Those are the three I consider others, and they are not associated with the defense or offense that I know of. So what I'm going to do is I'm going to go to hide those. I'm going to hide their averages, hide their industry, hide all three of those, and I'm going to hide their bubbles as well. And I'm going to go ahead and what I'm doing is breaking it down to you like an onion so you can see everything. So I'm going to go to the offensive group, and if you're not aware of what the offensive group is, that's the materials, the industry, the financials. That grouping is going to be materials, industrials, technology, consumer discretion, retail, financial, and I believe that's going to be it for the offensive stocks. And transportation is in there as well. Transportation is in the offensive stocks as well. So in the defensive stocks, you're going to get utilities, healthcare, staples, real estate, and gold. Those are all considered defensive. So let's go back to the sector rotation model, and we're going to, like I said, hide the other average, hide those, hide their bubbles. We're going to hide all the offensive and hide their bubbles as well. And we're going to go to the defensive. We're going to hide those, hide their averages, hide those, hide their bubbles. The major groups are going to be like the NASDAQ, the Dow Jones, the Russell. There's one more in there, but I'm going to hide those as well. But you can also, the reason why they're in there is because you can use them as for comparison. So we're going to not show their bubbles as well. And we're going to say okay. And just let everything come back up. And it just takes a minute because I got something else on the on another screen. Now I'm going to show you as well. And just give it a second to repopulate. As you can see, it's still above 70 Right now I have these set at Fibonacci levels. So you have your 100, your 90. 90 is not a Fibonacci, but I care about things being within 10%. And you have your 78.6, your 61.8, 50, 38.2, 28.6, I think it is. No, yeah. And then you have your 10% right here, and then you have your 0, which is your 52-week low within those labels. And right now, energy is still above 70. Like I said, that's why it's still bright green. But it's short term and long term averages have crossed. So I'm gonna put the simple averages on here. I'm gonna put 1 is 5, just a visual representation, and 1 at 21 to show you. She's gonna make that one, yeah. So this cyan color will be 5, and this orange line right here will actually be 21. So right now, that's what you're looking at within this label right here. So we can move over to staples, and I can show you the difference why staples is cyan and why energy is not cyan. And this right here is consumer staples. You can see right in here, this orange line right here is actual 21 simple move average, and the cyan line is the 5-day move average, simple move average, and they still have not crossed below. So that's pretty much what the label's just showing you right there. And this is the staples. This is why this one's still cyan. So I'm going to take that off. So I got rid of move averages, and one of the other things, if you haven't seen my other video about the 3 move average momentum indicator, that's basically what you're seeing right here. And this would change color. These little dots right here are the average of these 3 move averages. Before it was the closing price of the Heikin-Ashi, but I decided to go away from that and just do the average of the 3 move averages that I put in there. So right now, I'm using the high of the simple move average. I'm using the 21 period close. I'm using the 63 as the low moving average. Simple moving average as the low of the indicator. The reason why I did that, because I know this high is going to move faster than the close, so it's going to give you a better reaction, especially when in these in the dots of momentum changing. So, but your main focus is it being above its 21 move average. So that's your main focus right there. Is it above the 21-day move average right there? Price is above its 21-day moving average. That's the main focus when it comes to that momentum indicator. And also the dots in there, like I said, it changes color according to these dots spreading out together. And right now, as they are contracting, you got a red right there. And it's so it's a potential for the stock to actually move down. These different boxes that I've drawn are what's considered supply and demand zones. And you can see the staples have broken through all those demand zones. When it did fall down, it created these demand zones, while these supply zones were actually broken above. And now it made a new 52-week high. It was making a new 52-week high. And now it's in this period of resting right now, because we don't know where the market is actually going. And we can bring this one back up. And like I said, energy is making a round up. The VIX is kind of turning back around. S&P 500 is trying to go back up. And a lot of this stuff is geared towards the earnings. And Tesla holds pretty nice weighted in the S&P 500. And I was going to go ahead and just let me explain to you the top label, top indicator, and then I bring up the actual model. I can't remember the gentleman's name who actually created the sector rotation model, but I was going to bring it up and go through some of that. So up here in the labels, you get your day high, your 52-week high, your day low, 52-week low, your day mid, and your the mid of the 52-week. Your close from previous changing price from your previous close, and it's the same right here. 0.37, 0.37, because it's only one day from close to close. You get your day average price, and you get your 52-week average price as well. You get your relative strength is 79.34, and like I said before, anything that's above 70 will be bright green. But if the short average and the mid average if the short average is above the mid average, then it'll be cyan, showing that it has momentum in it. And you have your implied volatility, and that goes according to options. So let me go ahead and grab that model. Before I go into the model, this is one of the things I wanted to show you. I found this on YouTube. I just screenshotted it, and basically it shows you the different sectors. This be the offensive. This would be the offensive. Energy is by itself, and this would be defensive. But I did some further research, and that's why I moved those other ones into each one of those. And then I just averaged them out, and that's why you got the purple line, which is defensive, and then you got the blue line, which is offensive. And this was what the market cycle looked like. I grabbed this from the internet, and you can study it and see how everything works out. You see finance, technology, all this stuff is at the bottom of the market when they're at the bottom. And that's basically where everything is right now, at the bottom of the market. But we're actually somewhere over here today. But anyway, bull market, all this stuff takes off. Technology, industrial, all this stuff takes off. This blue line represents the actual economy. The red line represents the actual market. The market is a leading indicator for the economy. And you can really just study this whole entire model, and you'll see exactly where we are right now. Basic materials, energy, and staples. All this stuff is at the top of the market. When you see all that, you're at the top of the market. So I'm going to exit full screen. I'm going to bring this back up. I wanted to show you where staples, all these defensive sectors, except for healthcare. Healthcare took a blow, and right now it's below 50 but above 30. So you got materials, utilities, staples, real estate, energy, all this stuff at the top, just like the actual model was showing you. All these things are up right now, so it's actually time for the downturn in the possible. I'm not gonna say time for, but according to this model, it's a possible time for a downturn in the market. And once again, disclaimers: I'm not a financial advisor. The way I went about getting this information, because I was losing my tech stocks, and the old saying is what's the old saying? Necessity is the handmaiden of invention. So this is why I started creating this. And I started hearing people, especially on the pre-market prep show with Bazinga, talk about the sector rotation. And then I decided to do some research, and I started reading the books. And one of the books I had was IBD Investors Business Daily by William J. O'Neill, and a couple of other YouTube videos I watched on the sector rotation. And that's why I say this is just for information and educational purposes, not to tell you to do anything, but to help you make better decisions according to this model and other people who's come before us. But like I say, education for food for thought, really, and just something to think about. But for the most part, The stock market is the leading indicator, and the economy is the lagging. And right now, this is where I would say we were, but these healthcare stock coming down could mean we're moving over here where it says bear market. But I don't know. You have to wait for more confirmation because right now, energy and staples are still up. Healthcare took a turn, but energy and staples have not taken a turn, and we can go to the actual healthcare right now. And it just takes a second for everything to repopulate. And this is where healthcare is right now. Within the Fibonacci ratio, well, the Fibonacci numbers are in between the 52-week high and 52-week low. And I'm still going by the RS numbers or relative strength numbers. Right now, our relative strength number is 49. It's just below 50. And that's what you're seeing right here is just below this 50 midpoint of the 52-week high, 52-week low. And we come back over to healthcare, and it's still 32 points above the S&P 500. But it has a weighting in the S&P 500. So the S&P 500 is going down. Healthcare stocks, it's going to pull it down with it. Just like Ragi talks about with Simple. I think it's Simple Trading, her video. But she talks about the wave, the tide. Tide lifts all boats. And when the tide goes out, it brings all boats down. So the S&P 500 is the actual tide. The entire sector or the entire ETF is the tide, and when it's going up, it's going to raise all of those as well. So that's that, and I've forgotten to tell you what this red area is. It's the 52-week hot close, the highest close within 52 weeks, and the green area is the lowest close within 52 weeks as well. So I I wanted to make sure I explained that to you as well. And I wanted to include that in the indicator as well for a possible bounce. And it's actually where the S&P 500 is right now, if I remember correctly. Just got to give it a second to repopulate everything. And there you see the S&P 500 sitting right there on this 52-week close, the lowest 52-week close. It's sitting right there, and it's actually at my 10% fib as well, the one that I had drawn before in this area of demand right here as well, this box. So the S&P 500 is just sitting there, and it looks like it's going back up. 4.7. It closed at 4.17 today, but I'm guessing Facebook or some of the other tech giants had good numbers, and the S&P 500 is going back up. I meant to show you the different things you can change within the 3-move averages. Like I told you before, I had the price 1 is the fast, price 2 is the mid, price 3 is, the slow is price 3. And this is not that anymore. I need to change that. But it's the average of these 3. The anomalies, if you're not familiar with Wyckoff method, they're basically where price and the range of the high and low and volume are in make divergences, and it's an indication of from Ann Coulin's book where the market makers can be caught up or playing their little games. So it gives you evidence of what's possibly going on within the market, and you're gonna get those as well with this bundle, and that's what you're seeing right here. You have this. You have this very, very, well, I'm going to say this range between this high and low is smaller than the previous candle, but this volume is greater than that. So it's telling you that this candle significance is candle significance. And it's really a tug of war and a fight between the bulls and bears. And this candle over here is larger than the previous candle, but the volume is not greater. So it's giving you that indication right here with this triangle at the bottom. And it could represent a turnaround within the stock, but this one's at the bottom, this one's at the top, so it could mean a further downturn, especially with these appearing at the top rather than the bottom, like this one appeared at the bottom, so it turned around. This one appeared at the bottom, and that was an indication of a turnaround. But the ones that appear at the top is a continuation to the downside, if it is in the downside. Those are the anomalies. The sector rotation top one, you can see right now I have the week set at 52 week and show extra labels. It's just the labels on the side. You can go in here and change these. This is what controls the ratios. You can go in there and change any of those that you want to change them to. These are the 52-week high line, the 52-week low line, the 50. And then you have those other labels, like I said, they correspond with those right there. But you can change any of those that you want to change. And the short, average, and the mid average, they're just in there for that this box right here to change. The relative strength to change color. You get the volume, true volume buy sell pressure average. That'd be the other thing that's added to this bundle as well. As you can see, you have the regular, I put a cloud in there, that's all it is. But the blue line, the cyan line, is representative of average volume set on a 10-day basis. Right now I have it set at 10. And you have their ultra high volume, which is the pink line. Anything that crosses that, you'll get a white candle for ultra high, or you get a yellow candle for ultra high selling on those candles. And right now, this is just chaos right now. You got a yellow, white, yellow, and it's just chaos right now. So it just takes a minute for things to pick a direction right now in the market. As you can see, the VIX is above 30. So what else? These are my volume labels, the advanced volume labels. If I can get that to stop. You don't remember the last. This is it for each bar. Right now it's going to show the same thing. It's the day because we're on. But you're on the lower time frame. It'll be for that lower time frame. Bar average, bar buying average on each bar, and selling average on each bar. And you got your day, 10-day, and you have your 10-day average, week, buying on a weekly. These are all set of averages. That's why it takes averages time to catch up. I'm pretty sure I showed you that in my last video about these averages, but it just takes time for these to catch up. And right now it's magenta, showing you that it's very high volume to the downside for the day. And what else? These indicators, they're the sector rotation indicators specifically are meant to be used on a daily time frame. When you go into it, you can see I have it set for weekly and day. It's not meant to be used for a 4-hour or any of those lower time frames. If you decide to push it up, you're going to get an error message, or it's just not going to work for you. So one of the other time frames, like if I put this from a day to an actual month, the labels, I know the labels are going to go away. The volume is going to be just fine. And let me make sure. We'll put on 3 years. This is going to work just fine. And that's one of the other reasons why I went away from the labels. But anytime you have something in there with a specific time frame, you have to have it on lower time frames for those things to work. So it's not going to work on a monthly unless you go in there and change that stuff to a monthly time frame. And this is what it looks like with the SPY. And a lot of times you've seen in my other videos, I've gone back to the pandemic and really just looking at the sector rotation model. And we can look at volume as well. The labels aren't going to matter during this time because they're always looking at today or what's going on. Yeah, looking at today. But for the most part, you can see how everything switched up and changed down here within the actual model itself. You can see how everything just fell off a cliff, and the VIX, this orange line, just went straight on up and hit way above its 52-week high, and it was way above its average. How everything was just sloping down. And then the first thing that really came back was the defensive sector. Then the S&P 500. And energy was the lagger for this time period, this yellow right here. And cyan and everything just pushed up. And the S&P 500 average, it'll turn red if S&P 500 is below it. And it'll turn white if the S&P 500 is above it. And that's what you're seeing right here. The S&P 500, it's all green because it's above its 50. If it's in a downtrend, just like with the MACD, whether it's above 0 or below 0, you get those different colors with the MACD. But when it's in an uptrend, you get this bright green if it's above 50. And if it's in a downtrend or has some down days, you get the dark green with the S&P 500. But if it's below 50, you get dark red or you get bright red. Bright red would be continued downtrend. Dark red would be a uptrend if the S&P 500 is below its 50 line, 50 midpoint for its 52-week high, 52-week low, and everything lines up. And you can see how, like I said before, energy was the laggard, but back here at what is this 11/20, November 19th, 20, energy really just started ramping up as well and joining the fight up. And it was been up the whole time, even though it crossed below its average a couple of times. Even the defensive sector crossed below a little bit. But this is where we are today with everything that's kind of going down. The defensive sector was going up. Energy was going up. The S&P 500 tried to make its way back up, but it couldn't as well. And the other thing that I'm offering with this bundle is the 2.0 version. I showed you that version before, but let me show it to you one more time. The 2.0 version works more so like the MACD. It has a histogram, and your actual zero line is gonna be the 50, the midpoint for the S&P 500, midpoint for all of the different sectors that are added in here. Let me go ahead and peel back, like I said, the layers, and so you can see it. As you can see with this version of the indicator, it's more like the MACD. I left the averages the same. I left energy the same. I left both the average of defense and offense the same. I left energy the same as well. I left not MACD, but I left the VIX the same as well. And its average the same. But what I did with the S&P 500 was I took now looks like the MACD, like I've been saying earlier. You have the red, dark red, and then you have the green and bright green. But I imposed the offense and the defense on top of that. So the S&P 500 is now in the background or the base for all of this. And you can see how everything really just changed and switched up. And you can see how the offensive sector, the blue is still blue, and the magenta is still defensive. And you can see how it works with the S&P 500. And like I said before, the defensive sector came back first, then the S&P 500. You can see how the S&P 500 turned white, and the offensive sector turned cyan, and the defensive sector had already turned pink right there, showing you that it was above its average. and you can just watch the flow of it right there. Like I said before, this is built up like the MACD, but the zero line actually represents 50. And anything that's below is midpoint between this 52-week high, 52-week low will be considered negative, while anything above its midpoint between this 52-week high, 52-week low will be considered positive. And that's pretty much it. And this is where we are today, according to this indicator. Still have those labels in there: S&P 500, offense, defense, VIX, and energy. And like I said before, this is based off the MACD, so it's showing you the difference. And it's showing, the move as convergence, divergence. So right now it's showing you the difference between the offensive, defensive, and the S&P 500 in the background. As you can see, the defense is coming down as well. You can see how it's making its way down when it was the highest one up here, while the offensive and the S&P 500 was barely showing. And you can see these big red bars right here for the S&P 500. You can see right here, you had this ton of red right here, but it actually started making its way up according to the dark red. The close is actually higher than the previous close, and that's what you're seeing. This is the close down here, and this is the close for today. And if you look at it, the S&P 500 actually moving up after hours. It closed at 417. Now it's at 419. And everything... and you can see it down here as well. Like I said, this is the visual representation of what's going on in these labels and in the market. So this is the 2.0 version, sector rotation 2.0 version. So I'm going to actually push it over to the S&P 500. I'm going to show you one more indicator, but it's not going to be a part of this bundle. But I'll probably make it a part of the bundle as well. Those of you that are unfamiliar with my previous day volume profile, this is the updated version. Well, I'm not even going to call it updated version. This is another version that I've created. I started watching Tribeca Trading Group. I think that's what it's called. They have the whole market webs indicator, and it's an awesome indicator. And you get a chance, just check them out, Tribeca Trading Group. He does an end of the day recap as well, what's going on. But I also put my expansion fields in here. There's going to be a version of this indicator without the expansion fields as well. So let's push it over to the side and let's get in. Right now I have the volume nodes as yellow. And what I did was I did the same thing I did with my Better Darvas box. Right now I'm showing you a contrast between the value area high, the value area low, and the point of control. And that's what you're seeing right now. That's why these boxes all look different. Because this midline right here is the previous day's point of control. This high area is the previous day's value area high. And this lower area is the previous day volume area low. And these lines facing forward now that I have on expansion, this is today's value area low. This is today's value area, point of control, the white one. And this red line right here is today's value area high. So it's away from all the price. You can see price is within the area of the previous day's box area. And you can see how it's sitting on had this big volume node down here as support, and it's kind of breaking that, but it's actually trying to go back above as well. And this is just what do I call this? This is the VTO expansion profile with expansion fields in it. You can go in there and change all this stuff. They have bubbles and labels as well. So this the ones without the bubbles, this would be 1% away from the value area high. They don't have bubbles because I didn't feel like, I mean, it'd be just cluttered everything up. But we wanted to show it. If I wanted to show it to you actually on the daily as well. So I'm gonna get rid of everything else, and it just takes a second because I have all the other stuff on that other script still running as well. So this is what the actual indicator looks like. No nothing else there, and you can actually have those lines show up as well if you want those. The value area high, previous day value area high line, previous day value area low line, and the previous day point of control. You can actually have all that stuff show up. Right now, I have all that stuff unselected, and that's what you're seeing. And what you're seeing right here, that white line is the point of control expansion. That's why it has an X. Value area expansion, value area low expansion. And I'm going to push it up to a year. I'm going to change this to the monthly. And this is basically what you'll get. And you can see right now, the S&P 500 is below last month's point of control, which is the midpoint between these two areas and contrasting. And right now, this is the value area low. This is the current monthly value area low. This white line is the current point of control, and this red line is the current value area high. So, and you can see right now, it's almost right there on that that point, that 1% expansion level right there. You can look right here, actually made to a 3% expansion area right here, and beyond that is 5 and 8, so on and so forth. If you haven't watched my video on the volume profile with the expansion levels, it's out there. I'm not going to go into too much more detail because the video is already long enough. But you can see right now, this is the expansion, 5% expansion from the value area high. But you can actually, just like my original indicator, you can go in there, you can change it, and just flip the fibs, and it'll actually go to the POC, being the base for the expansion levels. And now it's going to show you everything away from the point of control. So if we're looking at today, or we're looking at now, this will be the point of control. This will be this white line is 1%. No, this white line, this gray line right here is 1%. This will be 2%, and this will be 3% away from the point of control. And I would put the point of control on there just to show you what I'm talking about. And this orange line is the previous point of control, while the white line is the current point of control. And you can see it throughout. You can see it throughout. This is the point of control, and the fibs are now based off of those, and they're expanding away from the point of control, and that's the expansion, fib expansion levels. And one other indicator I wanted to show, I know this video is packed full of indicators already, is the better MACD. Something that bothered me about the MACD was that these crosses at the top and the MACD would just turn flash red. And I didn't like that. So I changed this one to the better MACD. And I actually have the different price being colored as well according to the better MACD. And what this indicator actually is doing is showing you with the MACD cross, if the MACD line is blue line, and then its average is this white line. So if the histogram is actually, if the MACD is still below 0, but it's above its average, you get pink as an alert. But if the MACD line is above 0, you'll get green and it's above its average. But if the MACD line is actually turning down or whatever, or the difference is, or there's a convergence, like these two lines are getting close together, you get this lime green color. And then when they spread apart again, averages spread apart again, you get a bright green. Then when they converge again, when they're no longer expansion, but they're converging, you get the lime color, or this dirty green color. And when the MACD actually crosses, as long as the MACD is above 0, but it crosses below its average, you get dark green. And if the MACD is headed back above and it hasn't crossed below 0, you will get bright green. I mean, you get light green. But that color is there. That light green comes in the fact that the MACD line is actually still below its average. So this is what I consider the better MACD. And the same thing here, MACD crossed below 0, so you actually get the bright red. And then it started curling up, but it's still below its average. So you get this brick color or dark red color. And then once it crosses above its actual average, you'll get pink, but it's still below 0. So all this is happening and showing you still below 0. So it's not an area that you want to buy in. But take note of possibility of change. And you get orange when it's headed back down, but the pink is when it's headed up, but still below 0. But like I said before, when the MACD finally crosses above 0, you'll get cyan. But until then, you'll get pink as long as it's moving in that direction, just like with the regular MACD. And I actually put the regular MACD on here for reference. And I've left the averages the same, and you can see what I mean by the better MACD versus the other MACD. Versus the regular MACD. So, but this is gonna be the end of the video. I'll leave the link for the actual indicators in the description. I want to say I really appreciate you guys for taking the time to listen to what I had to say and the explanation behind the indicators themselves. Like I said, this indicator right here is going to be a part of a bundle. You'll be able to get, you'll be able to select between the MACD version of it, or I'm going to just say sector rotation model 2.0 versus the sector rotation model with just the lines. Is part of the bundle, or you can select just the sector rotation model. You'll get this version, and you'll get the labels by themselves, but you won't get the top version or any of the other indicators that I've shown you today. But like I said before, I really appreciate you guys for taking the time out to listen to what I had to say. And if you haven't already, please like and subscribe. This COVID, not COVID, but the vaccine is still kicking my tail, man. So I appreciate you bearing with me. I wish you all the best, and just be on the lookout for more videos. And please, if you have any questions or anything, please leave it in the comment section. Or if you had any ideas or any other improvements, just leave it in the comment section. And I wish you all happy trading, and God bless you all. I apologize. One thing I did forget to mention was a part of the bundle is you're going to get these changes. So this first one is a 5-day change. So it's the current close minus this 5-day. The monthly change is current close minus the 21 days, and this 3-month change is the current day close of minus its 63 day close. So you'll be able to see what's bullish and what's not. Is bullish short term, mid term, or long term. And right now, this is one of the ones that's bullish on all 3 terms. So I'm gonna look at that real quick, and then I'm gonna cut the video. And this is just Matt, and it's showing it's been bullish for all 3 periods, or all 3 periods right now. And that's the end of the video. I wish y'all the best. Have a great one.